Welcome back to this lesson number 8. In this lesson, I shall continue to explain a couple of other financial transactions and then how these financial transactions would be converted into accounting entries by adopting double entry system. Now, after this session, we shall be covering almost every financial transactions which a business entity does for carrying out day-to-day operations. So after the sessions, you will have a quiz. And after you complete the quiz, I'm pretty sure all of you would be equipped to handle any kind of financial transaction into accounting entries to double entry systems. Let us take an example. First, if I look at it, on 1/4/2020, Mr. X and Mr. Y deposits check of rupees 25 lakhs each as equity share capital of a newly formed XYZ Private Limited. So this gives you an example of a financial transactions. At the beginning of formation of a company, if this financial transaction is happening, how to convert into double entry system. So the first entry is debit. Why? It's an inflow. Second part, it's an immediate inflow in the form of a check. So balance sheet, asset, current assets, then bank amount is 50 lakhs. Why 25 lakhs each? Second entry, if you look at it, if first entry is a debit, second entry will be credit. And it's an inflow, temporary inflow. So balance sheet, liability, equity, capital, equity, capital is 50 lakhs. So this is an example where a financial transaction involving at the start of a company, if some capital is infused, how that particular financial transaction would be converted into accounting entries. Let us take another one. Now the company takes a factory on rent, and for this the company has paid rupees 3 lakhs at security deposits. When a company takes factory on rent, in that case it has to pay to the factory owner a security deposits. So what would be the first entry? It's an outflow. So that's why credit. Balance sheet, asset, current assets. Bank, because it is paying by check, amount is 3 lakhs. If first entry is a credit, second entry would be debit. Now, this debit means whether it's a temporary outflow or permanent outflow. If a company keeps a deposit, security deposits, it's a temporary outflow. So it would be in balance sheet. So the head would be debit, balance sheet, asset, non-current assets into, and then under the head security deposit 3 lakhs. What is a non-current asset? An asset which would be converted into cash after 1 year. So when a company takes factory on rent, ideally it should not take it for a year. It would be taking it beyond a year or more than a year. That's why it would be non-current assets. Third, let us take another example. The company on 4/4/2020, the company purchases a machinery of rupees 40 lakhs by paying a check. Same concept, it's an outflow of fund. So that's why credit. If it's an outflow, then credit. The first entry will be balance sheet, current assets, bank, because it's by check, 40 lakhs. Second entry would be debit, because first entry is credit, means second entry debit. Then whether it's a P&L item or balance sheet item. In this case, the company is purchasing something which would be used to generate sales in future or inflow in future. So definitely it would be balance sheet item. Asset, fixed assets, plant and machinery, rupees 40 lakhs. Because as we know, assets are of 3 types: fixed assets, non-current assets, current assets. Fixed assets means an asset which would be used for production purposes like land, building, and plant and machinery, etc. Let us take a couple of more examples. On 7/4/2020, the company purchases raw material worth of rupees 30 lakhs on 30 days credit. So first entry would be the credit because it's an outflow. Deferred outflow, balance sheet, liability, current liability, creditor, amount is 30 lakhs. Second entry would be debit, balance sheet, asset, current assets, raw material 30. Because why? From this raw material, it will generate future income. So that's why it is booked under assets. Current assets means within 1 year, it will be converted into sales. So What are the entries we have just covered? Company starting operations, where it raises capital, then it takes factory on rent, gives security deposits, then it is purchasing fixed assets, plant and machinery, and also for production it is starting the raw material. Next, the company incurs other manufacturing expenses to the tune of rupees 3 lakhs, and payment will be made after 30 days. Now, in this case, the outflow, so that's why credit, but deferred outflow. So balance sheet liability, current liability, creditor, amount is 3 lakhs. Next reason, is it a permanent or temporary? So that's a permanent outflow. That is balance sheet, P&L expenses, other manufacturing expenses, 3 lakhs. So what are the expenses? What are the financial transactions we have covered? At the beginning of the company, capital infusion, factory taking on rent, purchasing plant and machinery, purchasing raw material, incurring expenses for productions. As you can see, we are covering most of the transactions a business entity performs during the normal course of actions. Third, now in this case, another, not third, it's basically another financial transaction. On 28th April, the company takes loan for 3 years of rupees 20 lakhs from bank. So it's an inflow. Now that's why debit, balance sheet asset, current assets, bank, immediate in the form of a bank, 20 lakhs. Now if first entry is a debit, second entry will be credit. Now the second entry, what you look about credit, in this case, what is the reason of this inflow? It's a temporary or it's a permanent? Since it's a temporary, it will result in a future outflow. So that's why it is liability. Now, in the liability sections, if some liability has to be paid more than 1 year, then it will be classified as a non-current liability. In this case, the company is taking a loan for 3 years. So that's why it is non-current liability under the head loan of rupees 20 lakhs. Let us continue to take a couple of other examples. On 30/4/2020, the company incurs 2 lakhs expenses on account of salary for the month of April 20, and the payment will be made on May 5th. So in this case, it's a deferred outflow. So credit, balance sheet, liability, current liability, creditor 2 lakhs. It's an outflow on account of what? Temporary or permanent? Salary paid, it's a temporary or permanent outflow. So that's why debit, P&L expenses, salaries, 2 lakhs of rupees. Next, on 5th 2020, the company pays the salary of April, booked on 30th April. That means this salary it is paying on 5th of May by check. So on 5th of May, it's an outflow, immediate. Why? Because on 5th of May, it is paying by check. So balance sheet, asset, current assets, bank, because it's an outflow immediate in the form of a check. So that is the amount. Now look at the second entry. Second entry is on account of, expenses which is incurred past. So second entry will be debit, balance sheet, liability, creditor for expenses, and amount is 3 lakhs. So what does it say? A second entry is on account of some of the expenses which is booked in the past. So that's why it is debit, balance sheet, liability, creditor of 3 lakhs. Let us take another example. 7th of May, the company pays EMI of rupees 0.66 lakhs for this month. Out of this, interest is 0.20 lakhs. Same concept as we have discussed in the previous examples. EMI consists of two parts. One is interest, one is principal. So first is an outflow immediate in the form of a bank. So first entry is a credit, balance sheet, current assets, bank, amount is this. Second entry would be of two parts. One is on account of outflow for an inflow which has happened in the past. It's principal loan amount. And another part is the interest. So interest will go to the P&L and principal will go to the balance sheet. So balance sheet liability loan 0.46 lakhs, and in the case of an interest, this 0.20 lakhs is the P&L part. Let us take another one. On 16th of July, the company registered a sale on 45 days credit. So what are the financial transactions we have covered? Company starting, taking factory on rent, purchasing plant and machinery, purchasing raw material, incurring expenses, then taking a long-term loan, Then what we are talking about, also we are talking about that then what we have discussed apart from incurring expenses, then taking a loan, then we have said is that EMI payment. So all these most are the transaction a business entity incurs during the normal course of actions. On 16th of July, a company registered a sales of 30 lakhs on 45 days credit. So it's an inflow outflow. A sales means inflow. No, it's a deferred inflow. If it's a deferred inflow, debit balance sheet asset, current assets, receivable 30 lakhs. Now, for what reason inflow is happening? It is credit P&L income, and it is on account of sales of 30 lakhs. So if you look at it, this is the inflow is permanent. That is why credit P&L income sales is 30 lakhs. Let us look at another one. On 31/8/2020, the company realizes the credit sales of 16/7/2020 by way of bank transfer from its customer. So whatever the sales it is booked on credit, it is realizing on 31st of August. So first on 31st of August, it is immediate in the form of a check. So that's why debit, balance sheet, asset, current assets, bank. Now, what is the reason? It is the realization of previous receivable. So that's why what we talk about credit, balance sheet, asset, current assets, debtor of 30 lakhs. Last, company sold 20 lakhs worth of shares at 22 lakhs and the amount is received on bank account. So on that day, it's an immediate inflow. So debit, balance sheet, asset, current assets, bank 20 lakhs. And what would be the second entry? Credit. Now again, it has got two parts. One is some outflows happen in the past on account of that inflow. That part would be captured in the balance sheet, and the extra amount it has got will go to the P&L. So balance sheet, asset, non-current assets. Now balance sheet, asset, non-current assets under the head investment, it will 20 lakhs, and the P&L income gain from sales of investment, it will classify as the other income into two parts. Now if you see what are the financial transactions we have covered, let me repeat again. Company starting capital infusion, by then taking factory on rent, purchasing plant and machinery, purchasing raw material, incurring manufacturing expenses, then taking a loan, then repaying EMI, payment of salaries. Now payment of purchase of raw material when it is paying on whatever the previous raw material which is purchased on credit, it is paid. Next, generating sales on credit, and also it is realizing the sales from the debtors. Then EMI payment. Then what we say, also the sham investment, it is selling at a profit. So if you see 90% of the transaction a business entity incurs has been covered, and we have discussed that financial transaction, how it is converted into accounting entries by adopting double entry system. I am sure that in these 8 lessons, I have been able to cover a very important concept in a very simplified manner of converting financial transaction into accounting entries by following a process called double entry system. After these sessions, you will take a test of 10 questions. And from once you cover those 10 questions, you would be, I am pretty sure that you would be absolutely clear about the concept of double entry system, and more importantly, how to convert financial transaction into accounting entries. Thank you so much for watching this video.